Hello, let me welcome you for the video lecture series on management and economics. In this particular video, we will discuss the depreciation. The depreciation is the decrease in the value of a property with the passage of time. It is accounting concept which with individual decrease against the income tax. As per the business viewpoint, a physical asset has a value because one expects to receive the future monetary benefits through its possession and usage. Everybody would like to earn something through the business. The benefits are in the form of future cash flow resulting from the use of the asset or the product, like the goods or the services which you render. The ultimate sale of the asset, you will be earning the cash flow. The purpose of deduction is to provide for the recovery of capital that has invested in the physical properties. Second one, to enable the cost of depreciation to be the cost of producing the product or service that results from the use of the property. The depreciation cost deductible in computing the profits. That means after computing the profits, that will be deducted from the profit on which the income tax are paid. Definition: depreciation is the dimension in the value of fixed asset due to lapse of time or the usage of time, building, equipment, machinery, wear and tear. With the amount of usage of time, the worth does not remain the same as much as in the over a period of time. That means after a few years of time, the value will not remain same, it will decrease. The depreciation is defined as reduction in value. Causes of depreciation: because of usage of a particular product, you do the depreciation. Because of physical cause, the physically we will be running the vehicle or we will be running the particular product. Because of that, there will be a wear and tear. Because of that, there will be a decrease in the value. Abnormal occurrences like the accidents, like some are the problems which is associated with that, that also will have a depreciation. Technological development and change: as the technology changes, the earlier product becomes obsolete. Because of that, there is a depreciation which happens to the machineries or the equipments. Sudden failure: that means suddenly the product will fail because of some problem in the machinery. That also there will be a depreciation will be calculated. And depletion: that means over a period of time, because of the aging, the depletion will also occur. Methods of providing the depreciation: there are totally 9 methods that you have. The first one is a straight line method. It is a very simple method that you have. Second one is diminishing balance method or reduction balance method. That means over a period of time it keeps on diminishing, as the word says. Okay, so that is the second method. The production based method: that means here how much of production you do it, for that much you will be paying the depreciation or you will be cutting the depreciation. Either it may be a per unit basis or per hour basis. Okay. Next, repair provision method: that means you will be doing the depreciation to maintain or repair the particular equipment. The annuity method, the sinking fund method, the empowerment policy method, or the revaluation method, sum of the digits method. Out of these different types of method, the most commonly used is a straight line method or the diminishing balance method or the sinking fund methods will mostly or widely used in the market. Methods of calculating the depreciation is it is a time function. That means depreciation will be with respect to the time, and it is a function of usage. That means how much of used that particular component or the machinery that you have. And the third type is the function of use and time. That means they will take both the time as well as the usage of the particular component. It is a function of time and maintenance. It is a function of time and interest that is going to happen in the with respect to the component. Next is a straight line method or a fixed installment method. In this is the very simple method that you have. This method provides a depreciation by means of periodic changes over the assumed life of the asset. That means every component will have a shelf life. Based on that shelf life, we will be doing assess the depreciation. The depreciation per year is equal to C minus R divided by N, where C is the cost of the asset or the equipment, R is the residual value or the scrap value that you are going to earn when you after the usage of its life. Okay, then N is the estimated life of the machine. Let us see an example. A melting unit for a steel foundry was purchased at 40,000 rupees, and rupees 10,000 is being spent on its erection and commissioning. The estimated residual value after 10 years, that means estimated the scrap value after 10 years will be 12,000 rupees. How do you calculate the depreciation? By using a straight line method. The formula which we will be using is C minus R divided by N. Find the annual rate of depreciation. Second one, book value of the machine at the end of each year using the straight line depreciation, and plot the graph of number of years versus depreciation. And third one is depreciation fund collected at the end of 8th year. These three things he is asking you to calculate with the data which is being given there. That is, the cost of the machine is 40,000 rupees and erection cost is 10,000 rupees, and the time, the N is equal to 10 years, and the scrap value R is equal to 12,000. The total cost is equal to 40,000 rupees plus 10,000 rupees is the 50,000 rupees. Initially the person will invest. The salvage value is 12,000 rupees. The life is 10 years. Let us see a table. In this particular table, you can see the number of years, that is 1 to 10 years, the cost and balance. Initially it is 50,000 rupees you have invested. The depreciation per year will be calculated based on the calculation. Depreciation per year is equal to C minus R divided by N, which is equal to 50,000 minus 12,000 divided by 10 is 3,800. Okay, so this is a per year you will be deducting. The depreciation fund is the total fund for that particular year is 3,800. The book value of the depreciation is the 50,000 minus 3,800 will be 46,200. When it comes to the second year, the book value of the first year will be the cost and the balance of the second year. That is 46,200 will be the cost and the balance that you have for the second year. The depreciation will remain constant since it is a straight line method. The depreciation will be constant throughout the life period, that is 10 years. So for the second year, the book value is 46,200 and the depreciation is 3,800. The total depreciation that you will be having is 3,800 plus 3,800 is 7,600. And the book value 46,200 minus or 50,000 minus 7,600 will be 42,400. Similarly, for the third year, the depreciation will remain constant. The book value or the initial amount is the last period book value will be considered and the depreciation is constant. The total depreciation will be 7,600 plus 3,800. It will be 11,400. The book value will be 50,000 minus 11,400. Like this, you will be calculating for the 10th year. The total book value will be 12,000. That means the scrap value, the value of the scrap that you have sold the particular component. Okay. And the third one what he has asked is the depreciation fund collected at the end of 8th year. At the end of 8th year, the amount collected will be 19,600. It is 3,800 into 8 is equal to 30,400 will be collected at the end of 8th year. That means this is the value at the end of 8th year he has to calculate. And one more thing he has asked you in the example, that is plot the year versus the depreciation fund. So this is the year in the x-axis you have to plot and depreciation fund in the y-axis you have to plot, and you can able to get the graph. Let us see the next one more example that you have. An investment of rupees 5,000 in a new equipment is expected to have a salvage value of 1,000 rupees after 4 years of shelf life. Find the depreciation expenses by a straight line method. Plot the graph. Let us do the depreciation per year, C minus R divided by N. If you calculate that, that is 5,000 minus 1,000 divided by 4 will be equivalent to 1,000. That is the depreciation that you will be keeping aside or taking out every year. This is, you can see here, for all the 4 years it is 1,000 is being taken out as a depreciation. The initial cost will be 5,000 minus 1,000. The book value is 4,000. 4,000 will be the cost at the beginning of the second year, and depreciation will be 1,000. It will become 3,000. Similarly, if you go to the fourth year, the book value will be 1,000 and depreciation will also be 1,000. What is the advantage of this straight line method? The straight line method is frequently used in practice because it is very simple, that is easy to understand and simple to operate, and uniform annual charge after better comparative cost, and this method requires little work for calculation and depreciation. Disadvantages: the fixed asset do not exactly at the same rate during over a life period of time. That means if the life period is 5 years or 10 years, the amount of fixed asset will not be the same. It will be keeps on changing. So the second disadvantage that you have is a straight line method is mainly, in many cases, becomes unrealistic to collect the money. Let us see the next type of type that you have: reducing balance method or diminishing balance method or percentage book value method. As the name itself says, it is a diminishing balance method. It keeps on decreases. Okay, a fixed percentage of book value of the asset is deducted each period, and the book value decreases at a decreasing rate. This method, providing depreciation by means of periodical changes calculated as an constant of a balance asset after deducting the amounts previously provided. The depreciation percentage is calculated P is equal to 1 minus R by C to the power of 1 by N. If R is not given, that means the scrap value is not given, then you have to consider it as 1, not as 0, because 0 divided by something, it is not possible. Hence, the R is considered as 1 here. Let us see an example. The machine A and B are purchased for 12,000 rupees. The estimated useful life of the machine is 5 years. The estimated scrap value is 2,000 rupees. For machine A, straight line method, and for B, machine B, the reduced balance method can be used to calculate the depreciation every year. Compute the depreciation charges in the year for both the machine A and B and plot the graph, the number of years versus depreciation. What is given for the machine A and machine B is being shown here. That is, for the machine A, it is a straight line method. The formula which you will be using here is A is equal to C minus R divided by N. That is 12,000 minus 2,000, because that is 2,000 is the scrap value, divided by 5. That means 2,000 is the depreciation that you will be doing every year for the machine A. This you can see here. The depreciation for every year for the machine A is 2,000. The initial amount that you have invested is 12,000 rupees. The first year 2,000 rupees is the depreciation amount. The remaining amount will be 10,000. The 10,000 is taken for the second year, and depreciation again is 2,000, and the book value will be 8,000. Similarly, you go up to 5 years, the book value will be 2,000 for the machine A. Similarly, let us take up the machine B, where we have to calculate the depreciation by diminishing balance method or reducing balance method. The formula B is equal to, or P is equal to 1 minus R by C to the power of 1 by N. That is, from the given value, 1 minus R is the scrap value 2,000 divided by C is the initial investment, that is 12,000, to the power of 1 by 5. 5 is a time period that is given. If you calculate that, you will get the value as 0.3011. That is 30.11% is the value which you will get. If you put those values in the table, you will get the table like this. The serial number 1, 2, 3, 4, 5, that is 5 years. The cost of the machine, initially it will be 12,000 rupees you will be investing. The depreciation per year, this amount, that is 12,000 rupees multiplied by 0.3011 will give you 36,103 rupees 0.2 paisa. This particular amount will be subtracted by the 12,000. You will get 83,086 rupees 0.8 paisa. This is the book value at the first year, that is end of the first year. Thus, end of the first year book value will be taken as a initial value for the second year, and the depreciation will be calculated for 8,386 multiplied by 0.3011. You will get 2,525 rupees 26 paisa. The book value will be, this amount will be added with this. The amount of value that you will be getting is the addition of 3,613 plus the 2,525 will be the value that you will be getting. It is 5,861 rupees will be the value that you will be getting as a book value at the end of year 2. Similarly, if you go to that till the end of 5 years, the book value will remain 2001.08. That means that is a scrap value that you are going to get. Here, the depreciation keeps on decreasing every year. That is what we call it as a diminishing balance method. At the end of 5 years, you see the depreciation which has been collected. It is 862 rupees. It is a very small value that has been collected. That is where we call it as diminishing balance method. It keeps on coming down as the life of the machine is also increases. The productivity will come down. Hence, the depreciation will also comes down in this particular method. The next method is the production based method. The production based method, here the depreciation is provided by means of the fixed asset or rate per unit of production, and the number of production or the hours of production will be considered. It is calculated by dividing the value of asset by the estimated number of hours to be produced by its lifetime. Depreciation rate per unit is equal to value of the asset divided by number of units or number of hours produced. Let us take an example here. A machine costing around 2 lakh rupees has residual value of 1 lakh rupees after 10 years of service. The estimated rate of production is 8 units per hour. Using the production unit method, calculate the rate of depreciation. Assume 50 weeks in a year and 46 hours per week. The unit will run or the machinery will run. So the depreciation rate per unit is equal to 2 lakh rupees is the initial asset or initial investment. The value or the residual value is 1 lakh rupees, hence 2 lakh rupees minus 1 lakh rupees divided by 8 is the units per hour into 46 hours per week into 50 weeks per year into 10 years. Understood? So this is 8 units per hour. We will be producing it for how many weeks? That is for 46 hours a week and 50 weeks a year, and 10 years we will be doing the production in this particular machine. The amount of depreciation that you will get is 0.5437. That is the depreciation rate per unit will be 0.54 rupees. That means for every unit that you produce, 0.54 paisa is the depreciation, right? That has to be done. So if you are calculating the selling cost, you have to add up this 0.54 to your production cost, and then you have to sell it to the market. Years of sum of years digits method of depreciation. In this method, the book value of the asset decreases at a decreasing rate. That means as the book value decreases, even the depreciation decreases. The depreciation is calculated by means of differing time periodic rates calculated as follows. That means if n is the estimated life period, either it may be 5 or 10 or 20, whatever may be the life of the machine, is calculated for each period as a function in which the demonstrator is always the sum of the series of 1, 2, 3, 4 up to n. The numerator for the first period is n and the second period is n minus 1 and so on. This you can better understand if we take up a example and discuss. Now let us take an example here. An investment of rupees 5,900 for a new equipment is expected to have a salvage value of 1,000 rupees after 4 years. Using the sum of digit method, find out the depreciation for the year and the depreciation amount after 2 years. Let us see the data what he has given. Number of years is 1, 2, 3, 4. That is 4 years he has given. The sum of the years is 1 plus 2 plus 3 plus 4 is 10. The depreciation for the first year is 4 years of life that you have divided by 10. That is the sum of the years of digits that you have is 10 into 5,000 is the initial investment minus the scrap value. The salvage value is 1,000. If you calculate, you will get 1,960 as the depreciation for the year 1. For the second year, instead of 4 years, it becomes 3 years. That is n minus 1. N minus 1. But the sum of the years remains same. The sum of the years remains same. And the cost which you are investing will also remains same. That is 4,900. That is 5,900 minus 1,000. That is 4,900. If you calculate, the depreciation for the at the end of year 2 will be 1,470. Similarly, the depreciation for the third year is 2 divided by 10. That means the n minus 2. N is 4. 4 minus 2 is 2 years that you have. The amount that you will be collecting is as a depreciation is 980 rupees. Depreciation for the fourth year, that is 1 by 10, is 490 rupees will be the depreciation. What is the depreciation collected after 2 years? That is first year plus second year. That is 1960 plus 1470 will give you 3,430 rupees. That means in the first 2 years of its life, the major amount of depreciation is being collected. It has been much more lesser when in the third and the fourth year. The next method that you have is the sinking fund method. In this method, the assumption is set up a sinking fund. That means set up a fund that you can able to use it to replace the machinery or the asset that you have purchased at a proper time. At the end of useful life of the asset, the total amount in depreciation plus the compound interest, here the interest also will be taken into consideration, could become equal to the original cost of the fixed asset. If the original cost of the fixed asset is 50,000 rupees, the amount that you have collected by sinking fund method will also be 50,000 rupees, so that you can able to replace the new machine. The formula which you use for calculating the rate of depreciation by sinking fund method is I into C minus R divided by 1 plus I to the power of n minus 1, where I is the rate of interest, n is the expected life period, C is the investment, R is the salvage value of the equipment. Let us see an example here. A machine is purchased for rupees 40,000 rupees. The estimated life of the machine is 5 years. The scrap value is 15,000. The rate of interest on the depreciation is 10%, because interest we will be calculating here. Hence the rate of depreciation is 10%. I is 10%. Calculate the book value of the machine at the end of each year using the sinking fund method and plot the graph of number of years versus depreciation fund. Depreciation per year is equal to 1 into 4,000, that is the initial investment that you have done, minus the estimated life, minus the scrap value is 15,000 divided by 1 plus the depreciation rate of interest is 0.1 to the power of 5, that is 5 years. The estimated life period is 5 years minus 1. By calculating this, you will get a value of 4,094 rupees 93 paisa, 937 paisa. You can round it off to 2 digits here. Okay. So whenever you are plotting for 5 years, or whenever you are putting on the table for 5 years, the balance in the first year is 0, and the interest rate is also not calculated, and even the annual provision that you are having, that is 2 plus 3. Since 2 plus 3 is nothing is there, even it should be a dash here, nothing is been calculated here. Only the annual investment, that is First year, the annual investment will be 494. 4094 is the investment that you will be doing. That is the balance that you have at the end of first year, 4094.37. The book value will be 40,000 minus 4094.37 is nothing but 35905.06 is the book value that you are having. Okay. Whatever the balance amount that you have collected during the first year will become the balance for the second year. That is 4094.937 will be the balance. For this, interest rate is 10%. We will multiply by 0.1. It becomes 409.4937. This plus this, that is the balance plus interest, will be the annual provision for the second year. The amount collected for the second year, the beginning of the second year, will be 4504.4307. And the investment that you are going to do for the second year will be the 4094. That is same. The every year will be the same amount that you will be collecting. So 4094.937, and the balance will be 4504 plus 4094. It will be 8599. This 8599, if you subtract it from 40,000, you will get 31,400 is the book value. We will be considering the balance value for the third year. That means 8,599 rupees is the balance for the beginning of the third year. And if you consider the interest, that is 595 rupees multiplied by 0.1, you will get 859 rupees. If you add up these two things, that is the balance and the interest that you have earned, you will get 9,459. That is the annual provision at the beginning of the third year. And in the third year, we will be deducting an amount of 4094 again. And if you club the annual provision plus the annual investment, you will get the balance amount here. This balance amount will be deducted by 40,000, that is initial cost, whichever we have utilized for the machinery, that will be the book value. Similarly, if you calculate for 5 years, the amount it remains as a book value will be 15,000, and the balance that you will be having will be 24,999 rupees. Fine. So the amount that you will be collected for 4 years will be taken into consideration. Okay. The next is the tax concept that you will be discussing as per your syllabus. The tax is a system by which the government imposes the charges on the citizens and corporate to finance its expenses such as the defense, welfare, education, health, the infrastructure, etc. The tax is a compulsory payment to the government under any law. It can change by the government on goods, income, and any activity which is going to involve. The types of taxes is income tax, property tax, sales tax, excise tax are the major one. Apart from this, you also have some more types of taxes depending on the state and the central government in India. Okay. First, let us see the income tax. It is calculated based on the gross revenue minus certain allowable deduction and exemptions. What you can minus there for the gross revenue is some deductions and some exemptions. That let us see in the next slides what deductions will be there and what exemptions will be there for the income tax. The next one is the property tax. Property tax is calculated based on the earning what he is going to get from the real estate, business, and the personal property. Hence, they are dependent on the income or the profit that he is going to earn. That means what is the level of income that he is going to earn, what is the level of profit that he will be earning. Based on that, the property tax will be imposed. Sales tax, it is based on the purchase of goods or services. Excise tax, it is based on the sales of certain goods and services. Let us see the personal income tax. The income tax is the type of tax that government imposes on income generated by the business or individual employees. For a business peoples, like the corporates, like the partnership, the small business or self-employed business. Individuals, like wages, salaries and other types of income that he is going to get, will be imposed by the tax. How to calculate the income tax? There are 3 steps in which you can able to describe the deductions for the income tax. Okay, first you have to calculate the gross income that you are earning, that is, which includes the salary, HRA, leave travel allowance, LTA. HRA is house rent allowance, LTA is leave travel allowance, and other allowances that has been given by the organization. Take out the exemptions provided by the on the salary. That means HRA, house rent allowance, is the amount that is given by the company, and the same will be given to your owner, okay, or your rented person. If you are a rented person in an organization, in a society, you will be giving it as a rent, so that will not remain with you. It will come from the organization and it will go to the owner that you have. Okay, next is LTA, leave travel allowance. Okay, those will not be provided, you will be deducting, you will be having exemptions for that. After this, remove the standard deductions. That means presently the standard deductions which the government says is 50,000 rupees to arrive the net salary amount. That is a net salary by deducting the, by exempting and by deducting. Exempting the HRA and LTA and deduction of 50,000 rupees, you will get a net salary amount. Then add the income from the other sources. That is, if you are getting a interest from the deposit that you have gained, income from the any rent that you are receiving it, or income from any other properties that you are, or any other sources that you are getting, has to be added to that. Okay. Now the second step is to deduct the investment and expenses eligible under 80C. That means what are all the expenses that can be deductible under the 80C is EPF, that is Employee Provident Fund, PPF, sorry, it is a Public Provident Fund, mutual funds, home loans, health insurance and premiums, etc. can be deducted as per the 80C and 80D that you have. Okay. The third step is arriving at the net taxable income by deducting all the deductions from the gross income. The slab that you have for the taxation is up to 2,05,000 rupees. There is no tax. Above 2.5 lakhs, up to 5 lakhs, you have a tax of 5%. And if you are earning above 5 lakh rupees up to 10 lakh rupees, you have 20% tax. If you are earning above 10,000 rupees, 10 lakh rupees, you have to pay 30% tax. This is the slab that you have. Okay, the slab that you have is 0, 5%, 20% and 30%. 0 up to 2.5 lakhs. Between 2.5 to 5 lakhs, it is 5%. 5 lakhs to 10 lakhs, it is 20%. And above 10 lakhs, it is 30%. This is the slab that we have presently in our Indian tax. Let us see an example here. A person earns 15 lakh rupees per year and 10,000 rupees as an other income. How much he has to pay the tax? Let us do the calculation here. The income tax calculation, and the year 2021, the gross salary he has given, that is the gross salary that he earns is 15 lakh rupees, and out of that 10 lakh rupees will be the income from the other sources. Let us take that later. The gross salary that he earns is 15 lakhs. out of that HRA and the LTA is 2.5 lakhs, that he is getting minus 2.5 lakhs. Standard deduction is minus 50,000 rupees. The net salary will be 15 lakhs minus 3 lakhs will be 12 lakhs. The income from the other sources has to be added to this net salary. 12,000 rupees plus 10,000. Sorry, 12 lakh rupees plus 10,000 will be 2 lakh. Sorry, there is a mistake here, that is typographical error. It is 12 lakhs 10,000 rupees. Okay, so the deduction under the 80C, that is for the EPF, for the leave compensation, for the health insurance, that is 80D, for the 80TTA, for all these deductions that you have, the PF, assume that it is 1.5 lakhs he is paying for the deductions. And the standard deduction for 80D is 15,000, and the deduction under 80TTA will be minus 10,000 rupees. If you calculate all these things, out of 12 lakh rupees, the net income that need to be payable is 9 lakh 85,000. 9 lakh 85,000. Here it is 12 lakh. There is one is missing. 12 lakhs 10,000 rupees here. So there is a mistake here. Please do consider. The tax payable for the person who earns 15 lakh rupees is the slabs are like this, that is up to 2.5 lakh rupees 0, and between 2.5 lakhs to 5 lakhs, that means he is earning 2.5 lakhs. For the 2.5 lakhs he has to pay 5%. The 5% of 2.5 lakhs will be 12,500 rupees he has to pay, and between 5 lakhs to 10 lakhs he has to pay an amount of 10%, that is between 5 lakhs to 9.85 lakhs his amount will be 4.85 lakh. For 4.85 lakhs he has to pay 10%. It accounts to be 61,000. So totally, if you add up 12,500 rupees plus 61,000 rupees, the net income or the tax payable will be 73,500 if a person is earning 15 lakh rupees per year. Let us also discuss about the corporate income tax. Corporate income tax is a tax imposed on the net income of the company. That is, whatever the organization which is earning, whatever the net income which the organization earns, for that they have to pay the corporate tax. Companies, both private or public, registered, are liable to pay the tax. A domestic corporate entity with a turnover of 250 crore pays a flat rate of 25% corporate tax. The total revenue earned is more than 250 crores, has to pay a corporate tax of 30%. At present in India, the steel sector is the one who is paying the highest corporate tax. If it is a new manufacturing firm from this particular year, that is from the year 2019 to 2023, he has to pay 22% instead of 30% if he is earning more than 250 crores, and he has to pay 15% instead of 25% if he is earning less than 250 crores. For a new industries or a new manufacturing industries, there is a deduction or there is a slash by 8% who earns more than 250 crore, or who earns less than 250 crore, there is a 10% slash in the corporate tax as per the RBI. With this, we have completed the taxation deductions and the taxations. Okay, thank you very much.